Wells Fargo blew it big time. Then why don't investors seem to care? Join us as we take a deep dive into Wells Fargo to understand what exactly happened and what investors should expect going forward. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain and I'm your host. At Invest in the Family Radio, we believe that you can become a great investor. How? By building the right plan and then sticking to it. According to Warren Buffett, that's what it takes to set yourself apart. And everything we do here is meant to help you get there. So thanks for joining us. And also thanks for your patience with my voice as I am recovering from a recent cold. So thank you so much for that. And know that you can always find more at investinthefamily.com and subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. And if you'd like to join me on the path to becoming an intelligent investor, simply text the word JOIN FAMILY. That's one word, JOIN FAMILY, to the number 44222, or visit investinthefamily.com and sign up, and we'll be sure to take care of you so you don't miss a thing as we work together to become better investors. And I hope you enjoyed today's interview with Adam, the Dividend Sensei. All right, Adam, welcome back to the show.
Thanks for having me back, Brian.
Sure thing. Again, we've had some great conversations recently. We especially one on Ford that was I thoroughly enjoyed and really appreciated your insights regarding Ford and GM for that matter. Right now, I'd like to hear about Wells Fargo. Wells Fargo has been in the news, obviously, with the accusations about creating fake accounts. And then even, I don't have the paper in front of me right now, but there's even some more news. This is early November 2016 out today, negative regarding Wells Fargo. What's your take on what's been happening there and whether or not it's a good investment for people right now?
Well, so that's the thing. As with all scandals, it evolves over time, so it's kind of tough. And now, at first, some background. Wells Fargo. They were founded in 1852, and so at 164 years old, it's essentially the second oldest bank in America, only behind a Bank of New York Mellon that's like 300 years old. And their claim to fame was these guys can survive anything. They're very conservative banking culture, and it's like compared to say Citigroup or Bank of America, where in 2008 the financial crisis hits and their balance sheets are packed full of toxic credit default swaps, and it just blows a hole in everything, and the government needs to bail them out. And Wells Fargo, to give you an example, since 1970 they have posted profits every year, including 2008. And so these guys, they can literally, that's the thing. They are the gold standard of banking, Buffett's favorite bank. And even, Charlie Munger, Buffett's right-hand man, said to investors in a letter that Wells Fargo is such a well-run business that we almost hold it up as essentially the metric against every other potential investment. Are you a better investment than Wells Fargo? If yes, then we'll buy you as a company. If not, hey, just buy more Wells Fargo. And so that's the thing, is like that kind of premium brand and reputation for, quality and safe banking. And, it's the reason they were trading essentially at, 50% higher price to book value than any other of the big mega banks. And so, when this thing hit, my initial thought was, hey, this is just another crisis. They've, faced these kinds of things before, and it's not going to take down the bank. And, as it's unfolded, the more the information has come out, it's like, okay, my view of the bank has dimmed a bit, especially of management, because when it first came out, I gave management benefit of the doubt. You've got 264,000 employees, 5,000 people, committed fraud and had to be fired. And it's like, okay, I understand the issue is, the buck stops with you, but some stuff will always slip through the cracks and maybe you didn't know about it. And then the other shoe fell when we started finding out that, he went before Congress, their CEO, John Stumpf, and said, well, I knew as early as 2013, and, we've been investigating this through as early as 2011. And, we've been firing people periodically over it. And now it turns out, no, we had whistleblowers were sending letters and emails to not just Stumpf, but the board of directors as early as 2005.
Wow.
And so essentially, that's the thing, man. If you knew, and it's not even it that you have to understand like the context. What happened was Wells Fargo was very famous for, in addition to being a very conservative bank, they were one of the most profitable banks. And part of that was they would cross sell products. So, you'd have, the goal was to sell each customer. They wanted to have like a checking account, a savings account, mortgage, CDs, essentially sell 8 things to everybody. And their average was only about 6.3, but by far, I mean, it was, compared to where they were, say, 20 years ago, and compared to other banks like JP Morgan, Bank of America, those guys have maybe 4 or 5 cross-sell ratios. And these guys just like, they're top of the game. And so now it turns out that the way they did that was they created these sales quotas, and essentially, what whistleblowers were calling boiler room environment, where literally if you don't reach your quotas, you're going to get fired. And so, that's the thing. And when people tried to go and tell the higher ups and call the ethics hotline and say, hey, they're telling us that they're essentially pushing us to even commit fraud and just open fake accounts for people without telling them. Right. And so then this is essentially what really kind of killed my respect for Stump the CEO, was essentially it wasn't so much that the opening of the accounts, because they weren't, the employees who were doing this, they weren't trying to actually like steal people's money. I mean, in the end, about 2.3% of their accounts ended up being fraudulent, and an independent investigation found $2.6 million in incorrect fines were charged to consumers that Wells Fargo has paid back. So it wasn't the actual fraud itself wasn't a big thing. I mean, sometimes, yes, it would hurt someone's credit score, and Wells Fargo has actually gone back and contacted the credit agencies, and they're hunting down everyone who was harmed by it and making amends. But really, the thing that blew the scandal up and really destroyed the reputation of the bank, or at least harmed it to a point that it's going to take years to fix, is the cover up. And specifically, when people came to the executives and they went to the CEO and Stump for years would say, hey, the difference is the company culture. We care about people. It's not about, we're not like, Bank of America or Citigroup. We're not just trying to trade and move money around and do crazy stuff that could, that's dangerous and could blow up the economy. We're happy to just be traditional bankers serving our customers, putting their needs first, and look how it works. Very much kind of like, the fitting the Buffett mentality, where if you're a good company and you care about people and you do the right thing, well, you'll be richer than everyone else. Mm-hmm. So that's the kind of thing he was pushing. And so when the whistleblowers, ended up, contacting their higher ups and their managers who said, hey, we'll fire you. If you don't like it, sue us. We'll ban you from ever working in the industry again. And so they end up going to the CEO and going to the board of directors and, essentially saying, hey, rescue us from these evil people that are doing bad things that you don't know about. And essentially they didn't. They just kept on doing it and kept on increasing those sales quotas. And now essentially, that's essentially what happened, is that they covered it up, and they knew that it's covering it up and then letting the company blacklist thousands of employees. And in fact, some newspaper articles came out about they filled out U5 forms, they're a form that you fill out with the SEC in case like a bank will, say JP Morgan with the London whale, who was a rogue trader and cost them like $6 billion. You fill out a U5 and it basically blacklists them from the industry. Wow. And so they went ahead and they filled out on some of these people U5 saying, hey, we fired them because they weren't doing their jobs, and their job was to sell securities, and they refused to do it. And it turns out that even using a U5 on bankers is not right, because these are not securities traders. And essentially, no, they were supposed to be, you were wanting them to sell checking accounts, and they tried, they couldn't sell it enough of them, and so since you fired them over that and of trying to report fraud.
Wow.
And so really that's the thing that, it's essentially why I ended up, going against Stumpf, and I was glad that he was gone. They clawed back about $50 million from him, and now he's lost a bunch of retirement benefits. And Carrie Tolstead, who was the head of community banking, essentially the most responsible for this. She was kind of like the first line of defense when the whistleblowers were going to. She left in 2015, but they clawed back $19 million from her as well, and it cut off her severance and retirement benefits. And so, the issue now is that it's just going to take time to rebuild trust with consumers and rebuild their brand. But the big concern is, well, if essentially, the modern Wells Fargo happened when Wells Fargo merged with Norwest Bank, Minneapolis bank, in 1998. And essentially that's when this cross-selling culture really started up. So since then, these guys have been like on fire and just the most profitable big bank. And so now a lot of people are asking, well, now that we're not going to be doing this cross-selling, and now that the brand is, damaged, even when everything settles down, are we going to be any better than, say, JP Morgan? And then another more immediate concern is that a survey just came out about a month ago, actually, by a company called CG42. It's a consulting firm that they did a survey of 1,500 Wells Fargo customers, and they basically found that the perceptions of the bank's reputation we knew it was going to take a hit, but this essentially, they went from 60% positive to 24% positive, and 30% of customers say we're actively trying to leave the bank and go somewhere else. And so they estimate that might cost them $100 billion in deposits, about $8 billion a year in revenue, which is, put in perspective, that's about 10%.
Wow.
And so, it's right now with the low interest rate environment, banks are really struggling to just really keep sales flat and then try to use cost savings to boost earnings, and then, buy back shares and boost the dividends with that. And so a 10% hit, that's
a big deal.
Yes, very much so.
So as investors are looking at the situation right now, you've got people who are already invested, then people are deciding, hey, is this an opportunity? Like you mentioned, this is a long standing bank with a long history, known for surviving and making it through. They're well respected, or traditionally have been very well respected. And so you think, well, hey, so they've messed up, they made some mistakes, they're taking a hit. Is the hit a buying opportunity? And you started the podcast by saying that, well, part of the problem is it's still unfolding, and so there's a lot that's still unknown. But it sounds like it's probably, everyone needs to make their own decisions, but it's not necessarily a screaming opportunity for anybody. And it sounds like there's still room for a lot of caution as far as investors considering entering a position with Wells Fargo.
Yeah, no, I should say I own shares myself, and I was actually looking forward to a dip, but unfortunately, we really didn't get one. The price did go from a peak of 50 down about 13% to 43 when all this came out, but now it bounced back up to 46, and now it's hovering at 45.
So really, this hasn't affected valuations that badly.
Oh, no. And so that's the thing is what's likely going to happen is we're going to need to take a quarter or two to actually see how sales are going and, see how deposits are doing, because, well, that's the thing. Are those 30% of customers really going to leave, or are they just, angry and just telling survey, the pollsters basically, lies?
My guess is that they're just angry and they're not necessarily lying, but man, changing banks is annoying and it's frustrating. And I find it really hard to believe that many people are going to jump ship unless maybe they were directly impacted, because, just a random example, you probably get this, you get those things in the mail that, a bank will offer you $200 or $300 for starting an account with them and stuff for a certain period of time. And like, man, I'd love to have $300, but I don't want to mess with it, And so if I don't want to mess with it and someone's paying me to mess with it, I'm assuming there's probably a lot of people who feel the same way about switching their bank stuff around, but who knows? Yeah, it'll be interesting. So it sounds like most investors have said, okay, this is bad, but this is still a great bank. Let's not panic and get ridiculous as far as jumping ship and making any moves. That's helpful.
Yep.
Awesome. Adam, hey, thanks so much for coming on. This has been great insights into what's going on at Wells Fargo.
Always a pleasure, Brian.
See you, buddy. Well, hope you enjoyed the interview today with Adam, the Dividend Sensei. Remember, you can get full show notes with the links and other details at investinthefamily.com. And also don't forget to subscribe to the show at iTunes, Stitcher, or the Google Play Store. And if you want to receive or if you want to follow with me on the journey to becoming an intelligent investor, simply text the word join family. That's one word, join family, to the number 44222, or visit investinthefamily.com and sign up, and we'll make sure to take care of you. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.